Um, oh, thank you. Recording. And so if everyone can mute themselves, unless you have a question, we have people who will be checking chat, and we want this to be, kind of an like an engaging talk where all of us are involved, because our group, Advisors for Good, we're a group where we all like to get to know each other, talk about socially responsible investing, ESG. And so it's like a collaborative learning environment together. And so I'll tell you kind of what we're planning to do today, and then we can kind of jump into it. And so we're going to start with introductions for a couple of minutes of the two speakers that we have today. And then if anyone else wants to introduce themselves, we would love to get to know you. Why are you here? Why are you interested in ESG? If you want to unmute and talk for like 30 seconds after the guest introductions. And then we're going to do a questions and discussion focused on Rebecca from Ethic and Luke from Ethos ESG. Hi, Luke.
Hi, everyone. Apologies. Nice to see everyone.
Welcome. I was just giving, an overview of what we're going to do today. And so Rebecca and Luke will talk for about 20 minutes. I have some questions for you both. And then we would like to open it up to everyone for a conversation for hopefully about 30 minutes where we get to discuss, what we found interesting about what Rebecca and Luke had to say, any additional questions that we have. And then we'll wrap it up by telling you a little more about Advisors for Good and how you can get more involved with us. And so with that kind of overview, we'll kick it off. I'm your moderator today. I'm Ella Taylor. I have a firm called Ella Financial Advising located in Oakland. And we specialize in working with environmentally conscious people who are ready to align their money with their values to make positive change in the world. And so Rebecca, would you like to introduce yourself?
Would love to, and thanks for having me, Ellen. Nice to meet you, and Bob as well. So I'm Rebecca, who I'm a product manager on our sustainability team at Ethic. I'll tell you a little bit about Ethic, and then I can explain a little bit about my role as well. So Ethic is a sustainability-focused asset manager. We manage a little over $2 billion, primarily for family office clients and large RIAs. And what we're doing is we're really trying to build out sustainable public equity exposures. And we'll get into a lot of this, I think, with my role, and I would imagine, Luke, a lot of the areas that you're looking at as well. But a big part of my job is looking at how we're working with advisors and how we're building sustainable products. So the full life cycle, from how do you introduce sustainability and how do you have a conversation with your clients about what they care about? How do you build a product around that? So what does the data landscape look like? What is research saying is relevant for climate change and measurability, and bringing that all together into a product infrastructure. So at the heart of what I'm doing and what Ethic does is technology. So a lot of those are really interesting technology and infrastructure problems. How do you ingest data? Where do you get it? How do you keep the quality high? Where's the research coming from? How do you vet it? How does that intersect with our portfolio management capabilities, all the way through what I think is the really fun part, which is how do you communicate what you're doing and if that's working, and adapt over time. So I think part of that is quantitative, so developing impact measurement systems, and part of that is more qualitative, so storytelling and bringing in more of the creative and content and storytelling and education elements of it as well. So that's a little bit about what we do, what I do. I'm really looking forward. A big part of product management is hearing from people that we're building tools for. And so a big piece for me and what I'm excited about is just hearing what some of the challenges are, what's going well, what's not going well, and seeing how we can help.
Cool. Thanks, Rebecca. Luke, do you want to introduce yourself?
Yeah, thank you. It's great to meet everyone and see some familiar faces. Thank you very much for having me. I'm the CEO and founder of Ethos ESG. Started this in 2019, and we really focus on collecting or aggregating a lot of data related to impact and ESG broadly, using that data in many ways for wealth managers primarily a data service software company, doing a lot of client-facing reporting, a lot of portfolio analytics. At our core, we're a data company, I would say data collector, a data analyst company where we are looking at organizing, cleaning, providing raw data related to climate, social issues, governance issues, a whole variety of issues or causes. That raw data from indicators or metrics to screens to controversies to a variety of things. And then making all that data very useful for, as you mentioned, the qualitative and quantitative side of this with client storytelling and reporting, as well as some of the quantitative portfolio analytics and investment analysis. And so yeah, I would say an exciting time to be part of be looking at ESG data, both on the political side, a lot of stuff going on, but also on the data side, a lot of data and clients, a lot of stuff going on. It's really exciting for standardizing data a little bit more, a lot of very rapidly evolving new data sets that are coming out that can be used both qualitative and quantitative. So yeah, really excited to talk with you all, and great to be here. Thank you.
Yeah, thanks, Luke. Yeah, thank you both of you for joining us. And anyone in the, anyone in the, I don't know, audience or, the people who are joining that want to come off mute for a couple seconds and kind of tell us, why are you here or anything that you want to get out of this?
Richard Mosley checking in. Can you hear me?
Yeah.
Yep.
Tara, do you want to speak?
Sure. Richard, I didn't know if you wanted to introduce yourself or not, or if you were just
Trying
can-
to, if
we
you hear
can
me?
hear you. Yeah. So how
All
about
right,
you go?
I'll make it brief. I'm part of this call because I'm a huge fan of Tara. Anything she says is a good idea is a good idea. Also, I'm old enough, maybe not quite as old as Bob, but pretty close, to remember when ESG was a thing, before it was a thing. So I've been very interested to see it develop into a product, such as you guys are building your business around, and seeing how that works and how it differentiates itself in the marketplace. And obviously, it's a very important sector to our clients, which are small family offices. And I'm driving, so that's why I'm being somewhat incoherent. So I'm going to put myself on mute. Thanks.
Thanks, Richard. Thanks for joining us.
Yes.
Anyone else?
I'll go. I'm Tara Bansal. I got here through bobbing, similar to Richard. Like I like Bob as a person, and I love building this community, and I really am here to learn. I don't know that much about ESG, but I believe we can use our money in good ways, and so how to do that in the most impactful way. But I want to learn, so that's why I'm here.
Cool. Thanks, Tara.
Tara, I'm also from Princeton, so I love seeing that.
Anyone else? Going. Bob?
Well, since Richard called out my age, I think I ought to respond, which is that I actually did come, I'm not on my defense so much as to say that I actually came to contact with this space back in the 80s when there was something called ethical investing. In fact, there was a book by that title. And so it's been a long time coming. But I also wanted to just take this moment to, since Luke kind of mentioned in the context of his introduction a couple of times, qualitative data, which is I find really intriguing because most of us associate data with something in terms of numbers, and qualitative data sounds something pretty different. So something that we can come back to later.
Oh, wait, Bob, we can't hear you now.
Oh, I was just saying that may be something.
Okay. Yeah, I'll come back to that.
What we think of as data, qualitative data.
Mhm. Well, and I think to your point, that's what individual clients care about for the most part. They do care about the, the sustainability and kind of the metrics, but really what gets them involved is you know, the story and the personal connection. So I think we'll jump right into talking to Rebecca and Luke about data.
And Catherine, it looked like you were going to introduce yourself, so I'm going to
please
jump
go,
in.
Catherine, I'm sorry.
Yeah, no, I just figured I join a lot of these and my videos also. I was like, if you're asking for introductions, I'll say hi. I'm physically located in Rochester, New York, but I work for a firm, Values Added Financial, based in DC. We actually are customers of Ethic and use it with our clients. My big goal whenever I'm attending things like this, what I want ESG investing to look like, I want it to operate in the way of that a consumer boycott does, that I want divestment to harm the companies, and yet it doesn't. And the bigger rabbit hole that I always go down is the more we kind of look at the data and the screenings, it becomes this black box of figuring out, like, there's no perfectly ethical company, and how does one, evaluate the trade-offs, and the fact that we're talking about secondary market securities that, like, whether I own it or a big pension fund owns it doesn't dramatically change the bottom line of the company. Like, I have clients that come, well, I don't want ExxonMobil getting my money. And I was like, that's not how it works. And so it's just a really hard spin. So I have a lot of personal kind of things that I wrestle with in trying to help. I think that people think that the investing lens is a way to move the needle more than it actually does, and to kind of keep a two-headed approach, that there's regulations and policy changes that are actually what's needed to create the change we desire to see. And I just appreciate when that's acknowledged in forums, and that, we're maybe doing less than people think that we are through this investing approach.
Yeah. Thank you, Catherine. I think that's really, really helpful. And I definitely think we should come back to that in kind of the group discussion, because I don't know, getting ready for this, I was thinking about stuff like that too, and kind of, I don't know, how to really make the change that we want to see, and what does that look like. And so Rebecca and Luke, I think we'll start with some questions, and ideally it's kind of a conversation of talking to each other, engaging everyone. And so we'll start with kind of the big questions of, and I think Catherine kind of led into this, of why should we care about ESG data? Which is a big open-ended question.
Asking the hard stuff first.
Go ahead, Rebecca, if you want to go first.
Yeah, I'm happy to. We always, I feel like, dance this dance. Who goes first? I think a bunch of you have touched on a lot of these different issues in some of the questions that you're asking, and I think we'll dive into some of the interesting parts of them. I think primarily, and I think what I love about the group that Bob's put together and the way that he's described it to me, is there's a growing group of people who care about issues, and you realize that there's a connection through to financial products. Under that umbrella, there's a whole bunch of different considerations. I think when you're an advisor, you're looking at the wealth management space, there's a values alignment piece. I think, Catherine, you mentioned this. Your client doesn't want to be invested in ExxonMobil. How is that possible? How do you know? Why is Exxon bad? What is the impact that they're having? I think that's where some of the data and measurement pieces come in. So there's definitely a values alignment piece, and a motivations, just personal values alignment piece. I think there's a huge risk piece, and I think this is getting into a little bit of how do you move the needle. But I think what we're seeing is in the financial industry in general, there's a huge umbrella that now sits under ESG of data that is capturing different impacts on the world that have previously been unaccounted for. And I think, Luke, this probably sits more in your world, which is, what are those different metrics, and how are you looking at carbon? How are you looking at the trajectory of the world and saying there's stranded asset risk here, or there's carbon risk here, and actually modeling that out against real life consequences that financial products have through the impacts that they have on the world. So there's definitely a risk lens. And I think that's where, if you leave aside political debate or values alignment or what people care about, there's a huge argument, and increasingly an argument that people are trying to make from a quantitative sense, which is basically saying, if you don't account for this, that's going to cause financial harm. Your returns are not going to be as good. Your performance is not going to be as good unless you start thinking about these different issues and the impact that that has on actual company behavior, but also on performance. And I think the last one is that comes to mind. There's so much under here, but I think there's an actual impact piece, which is how do you actually, if what you're trying to do, I think someone mentioned, you want to harm the company from a cost of capital perspective or whatever it might be. I think the goal that sort of sits behind that is how do you actually change corporate behavior so it aligns with the world that we want to see. And I think there's a few different mechanisms that we can talk through in there, and especially in investing in the world that we're in, which is, where you allocate your dollars is sort of one decision that you make. And then there's a whole bunch of considerations there around divestment and, if you don't own the shares, who else is going to? And there's a whole other area that I think I personally and we at Ethic are increasingly interested in as well, around shareholder engagement and how do you actually use, if you're going to be invested in certain types of companies for whatever consideration that might be, maybe it's a measurement gap, maybe it's a tax reason, maybe it's you were early employee at Apple and have a ton of Apple shares and you can't sell them for whatever reason. There's any number of reasons you could hold a company. So once you do that, how do you actually engage with the company in order to actually affect corporate behavior? So I think there's a whole bunch of considerations under there. And I think it's a great introductory question for introducing a lot of the concepts that I would love to talk through. Luke, I'm sure you have a little bit of a more data-driven way of looking at that.
Yeah, well, thank you. I think all of the goals you mentioned, Rebecca, makes sense. Whether you are looking at risk, impact, values alignment, other goals. So one vertical to look at is goals. Another vertical where data is important is the theory of change. If your theory of change is for shareholder engagement, or if it's for exclusion, or any of those other goals or theory of change, whatever you're trying to accomplish, data underlies all of that. Obviously, whether the data is accurate or not, so whatever your methodology is, the sources you use, ESG data is core to achieving whatever you're trying to do, whether that is values or impact or risk or changing companies' behavior. Having accurate, appropriate metrics that you're using to measure impact or values or risk, being able to measure accurately, sort of core to any goal that you're trying to do related to ESG. That's why I think it's so fundamental to, really to every discussion about either values, impact, or ESG related risk. On the flip side, it's also often used from a marketing, or often misused from a marketing branding perspective, where companies are using ESG data or making net zero commitments or whatever the data is. That it's if you, as an investor or an advisor or asset manager, don't have clarity on whether that is accurate or not, or what the purpose is behind that data, there's really a lot of confusion out there and a lot of difficulty for an investor's understanding. What does this data mean for me as an investor? Can I trust it? Really, it's very difficult to make a decision or make progress toward whatever that goal is you're trying to achieve, impact or otherwise, unless you have accurate data you can trust, that you know what its methodology is, what it's saying, can really be used and misused in many ways. So that's why I'm really passionate about Ethos. What we try to do is be extremely transparent, show underlying metrics, show what we're using, what we're trying to say, what we're trying to point to, what the raw data is, trying to clean and vet that data. ESG data generally still has a long ways to go. It's I'm sure you're all aware of the different ratings agencies. Every company, there's little standardization here in the US, especially. So it's still a long ways to go until we get anywhere near the financial data sophistication. But moving in that direction, where there is hopefully more standardization on the road, on the horizon, to just make it a more of a understandable foundation where you can build on that ESG data to pursue impact or values or risk mitigation goals.
Mm-hmm. Luke, you just led right into my next question perfectly, of kind of what is the state of play with ESG data? right? I remember even just a few years ago, a lot of it was like self-reported, and we're like, I don't know. And so kind of what's happening now, and, you know, where are we now, and kind of what's the direction that we're going in?
I think there's still a lot of self-reported data. Still, like every ratings agency, most analyses of company or fund impact or guidelines still rely heavily on self-reported data. It's, EU is farther ahead than the US, more regulation, more standardization, but still early there, I would say. US is earlier as far as standardized reporting. Also, a lot of variation between large cap, tends to be more reported, slightly higher percentage of independent audits or independent assessments being done, but still pretty, very low, I'd say 10 to 15% is a rough guess of what is number of percentage of self-reported data that is independent audits attached to it. So yeah, difficult to trust. That's one bucket. So there is an increasing number of third parties like Ethos, like Ethic, like other data-focused nonprofits, like As You Sow, others that are trying to assess that self-reported data to say, do we believe this is credible? Yes or no? Like, what is the quality of the methodology behind this self-reported data? Do they have any independent assessments where they're going through? So moving towards that independent assessment being a part of the self-reported data. What we try to do at Ethos to mitigate that self-reporting issue is one, look at government data. There are a lot of other sources like EPA or OSHA here in the US, or government fines and violations data. Two, we rely on some of those nonprofits like As You Sow and others who are doing some additional assessment of the self-reported data to say, do we believe this is credible? And then four, we also do some of this, our own analysis where Bob, you mentioned qualitative. We do some quantitative and qualitative of our own analysis. We're looking at like public sentiment using public media reports, looking at some sort of qualitative core business model assessments. For example, Tesla is always a good example. Their core business model is very focused on EVs, obviously, and shifting the car industry to be more sustainable, to totally reduce GHG emissions. So from a climate perspective, Tesla's core business model, I would say, is very clearly a positive, should score very highly. Tesla does not disclose a lot of its stuff. It hasn't historically disclosed lots. It often gets dinged from some of the ratings companies, or some self-reported doesn't do a fantastic job of disclosing its own information. So we try to mitigate that self-disclosure problem with assessment of the core business model and say, does this core business model support sustainability or social issues or a whole variety of ESG-related issues? I think as we get more standardized, we'll be able to rely more on self-reported information over time.
Yeah. You want to add to that, Rebecca?
Yeah, I mean, all kinds of great information there. I think the zooming out a little bit, when you originally asked the question, Ella, I think I think in general, there's a few trends that are happening that are quite good. I think there's, you know, when I started Ethic in 2016, and I think then there were a few of the leaders doing ESG data, Sustainalytics, MSCI, the sort of standard players. And I think since then, there's a bunch of trends that are reassuring, I think, but not enough. Maybe I think Luke and I would agree on that. Is there's more providers in the space that are doing those sort of core ESG ratings. Whether or not that's effective or not, I think is a totally different question. I think there's an increase in disclosure across a bunch of different topics, partially driven by regulation, especially when you look into Europe. And a lot of those, policy and reporting requirements coming out and increase towards standardization is definitely starting to happen, even if it's not fully materialized. But I think the way that Luke framed the problem is exactly how we think about it at Ethic, which is in the absence of perfectly reported and methodologically consistent data, how do you have a full picture of what a company's impacts are? And I think company reported data and having more consistency and coverage and things like that, you want everyone to be reporting on carbon in the same way is a great, there's a lot of people working on how to do that. I think SASB, some of those, there's a lot of people working on that problem, but the broader problem, I think, for for everyone is how do you create that holistic picture around, you look at Tesla and you want to assess carbon, you can look at fines, you can look at reported data, you can look at any number of other sources to get a more holistic picture, I think is exactly what we want to be doing. So that we're not reliant on one type of data or one type of especially self-reported data to make good decisions. The other piece that I'm especially interested in, this is a little bit on the like nerdy tech side of my job, is there's a lot of really interesting quantitative methodologies as well that I think we're at the very, very beginning of. I think recently we worked on something around how do you take quantitative modeling methods and actually fill in data gaps. So, there's, I think in a lot of different types of metrics, carbon, wastewater, hazardous waste, there's so many gaps in terms of what companies, even companies like, you would expect, like Rio Tinto is a huge mining company. You'd expect that they would have non-zero hazardous waste. And yet in a lot of the data, you have it's just showing up as blank or zero because they're not reporting that data. How do you actually use modeling techniques that data and technology firms have been using on the financial side, and then apply that to sustainability and impact data to get a fuller picture, at least a higher probability answer. We don't think that Rio Tinto has zero, and so in the absence of that, what's a better approximation of what that would be? So I think there's some really interesting work, I think, on the technology side there as well. That's starting to emerge. I think there's a huge question in because that data is not data that's traditionally been used in finance. I think from a regulatory point of view, that's sort of one of the problems we're looking at is what reliability do you want on data that's going into an investment decision? Is a question that I think the SEC is starting to grapple with, and is an emerging topic that everyone is sort of looking at from a reliability and quality point of view.
Yeah, that leads into Tara had a question about where is standardization coming into the industry? I think I've seen a few kind of things that like the SEC is trying to put together, different organizations. And so do you see any kind of trends in standardization?
I think there's the governmental one, like SEC has issued some thoughts on it. Still very early with SEC in the US. I think there will be some from SEC, potentially others in the US from governmental, and then EU governmental regulation is they're farther ahead with some regulations for disclosure and then for fund reporting. I think apart from governmental, though, there's some international organizations that are trying to standardize GRI, TCFD, SASB, just kind of alphabet soup of different international organizations trying to harmonize their standards. That's still, unfortunately, also pretty early. But at base, I think everyone is trying to get to the same standard data points of scope 1, 2, and 3 emissions, carbon intensity, reduction, water, waste, at least as a core base for ESG data, then social diversity and employee stats. It's often the same indicators that we're trying to track. Just it is important that eventually those will be harmonized methodologies for reporting, but there's at least some broad alignment on some of the core metrics and starting points.
Yeah, I would also add, I think there's for different audiences, different pushes towards standardization. So on the on the company and disclosure side, I think that's where a lot of standardization, all the things Luke just mentioned, carbon, diversity metrics, whatever that is. There's a lot of a push towards standardization, a lot of organizations working on who should be disclosing what from a company perspective. And then in the asset management landscape, I think Europe is the example of this, and I can't keep all the acronyms straight, but a lot of the regulation that's coming out is specifically for asset managers on what data can actually go into products and how do you categorize the different types of data that are going in there. I think people are kind of going, oh, it's the Wild West of what's an ESG product and how that's defined and what kind of data goes in there, and they're creating this sort of first push towards standardization in terms of going, okay, this type of data means this type of product, and helping people make sense of that product landscape. And so I think some interesting things, especially in the asset management, like product creation side, are happening in Europe. But I think that's a huge question for advisors is, if there's a spectrum from, prosecutable fraud on one side, as in you said it was an ESG product and you said that you were looking at methodology and you're actually just not. That's on one of the spectrum where I think recently there's I think the SEC fined, don't quote me on this, Bank of New York, for exactly this, as they said they had ESG in their methodology, but they actually had no process around actually enforcing that. So that's, I think, on one end of the spectrum, you have like prosecutable fraud under existing legislation. You cannot do that. It's not good consumer practice. And then on the far other end of the spectrum is whatever we would define as a really, really strong ESG product. And I think increasingly the role of a lot of advisors is helping make sense of that landscape. Where are you in there, and how do you know what's closer to the fraud side or closer to no standardization or bad data going in, and what's closer to the high impact? We really think this can move the needle. I think that's what everyone's grappling with the moment from different lenses. I think I would imagine across all of this group, especially.
Yeah, we've definitely heard from more advisor clients. They've been getting inquiries from SEC about their ESG methodology, if they claim to be sustainable or ESG focused, and SEC is increasingly interested in how are you doing that. So I think generally from a risk fraud perspective, it's do you have a sound methodology? And it's not here's the right methodology, it's do you have a sound methodology in place to assess ESG?
Yeah, that's all. Yeah, I find this all so fascinating. And it leads me to another question that's not on our list, but one that I've been grappling with this week is kind of consistent naming conventions around, different products. Like an example is this week, a friend of mine sent me like a DFA social portfolio, right? And in my mind, I'm like, social is like diversity, equality, things like that. And then looking at the prospectus, it's, a Catholic focus of like no abortion, stem cell research, things like that. And so it really got me thinking about kind of consistent naming conventions, right? Like where we're talking about, do you have a methodology in place? Yeah, that's great. But then kind of what's the convention of consistent naming?
I can start on that one because I think that's something we work to deconstruct, because I think with you're never gonna have a perfect naming system. I think what the underlying problem is how do you take someone's intentions or motivations for finding a certain product and then actually match that based on what's actually happening in the product. I think the way that we think about that at Ethic is naming, and especially when there's a lot of lingo and jargon around ESG and finance coming together, can be very difficult to navigate. And so I think that the approach that we've taken is people don't talk about social as what they care about. You would say, I care about human rights, I care about racial equality, whatever that might be. And then I think there's a huge missing piece in general in finance. And this is something we've been trying to do, of creating that interpretability lens on top of the data. So connecting what someone cares about. So say they care about racial justice into the actual data landscape. What data should you even be looking at? That could be very, if you care about racial justice, it could be a lot of overlap in terms of something that a Catholic investor cares about. There's a lot of overlap in terms of worker safety and human rights practices and things like that. But what we're trying to do is connect what someone cares about and how they would actually talk about it, in ways that you interact with in culture, movies, reading the news, and then actually using that as a lens to translate the data universe, because otherwise you end up in these wildly divergent definitions of what the same words could mean. I think a good example of this is in there was a study that was done on a lot of the leading institutional data providers in terms of how they're rolling up methodologies for environment and social and governance. And it basically showed that there was a huge divergence in terms of how those methodologies rolled up. And a lot of that is coming because things are being categorized differently. And people are creating, in the absence of standardization around how that happens, people are creating their own just from intuition or from whatever that might be. And I think that's a huge, it's that type of standardization I almost don't think you need, because you want the translation from what someone cares about into the data universe, and you want to connect that through academic work and NGO work and people that are doing a lot of great work on defining, you should care about air pollution if you care about racial justice, and here's why, and you should care about hazardous waste disproportionately harming communities of color And here's why, and interpreting the data universe that way rather than creating these arbitrary naming conventions around. We've seen some ridiculous fun names over time. But I think a lot of it comes down to like investor intentions and connecting that through to the actual methodology of what's happening in the product.
Mhm.
And one good example, Rebecca, of miscategorization, maybe board diversity is often categorized. So this gender board diversity can be a social issue. A lot of the gender equality ones can be either governance or social. Just one quick example of that. But would also agree there's a big difference between the compliance concerns or reporting and then client preferences and client reporting and categorizing things for clients who care about racial justice or combination of 10 different issues. Definitely one thing we try to do as well as through a simple questionnaire and through some other reporting, let clients pick, say, I care about X, Y, and Z, and then do reporting around those specific causes. If you design a model portfolio or you have a model portfolio or designing a custom portfolio for a client, being able to tailor that. On the fun side, I think I totally agree that there's really a alphabet soup and a lack of standardization here too, but broadly, I think moving away from the previously socially responsible investing 30 plus years ago, now was the indicator for impact related investing or values investing. I think that social, Ella, to your point, social has moved more towards faith-based values recently. I would broadly say social is moving in that direction. Impact is gaining momentum as a name for impact-related investments or anything that tries to have an impact on climate or gender equality, other issue. ESG is, I think, moving towards a little bit more of that risk mitigation focus, or you integrate some ESG considerations. And then there's all the faith-based values that are named separately, but yeah, definitely there's still a long ways to go in standardizing the names there too.
Yeah,
Well,
I think.
oh yeah, go.
Oh, sorry, I was just gonna add that I think a good example of that, just from a purely human point of view, is why do people care about climate change? There's so many different motivations for that. For actually looking at climate and companies having climate impact, you could look at that from, and I think Lily from our team's on the call, she knows this quite well, is you could care about climate because it has really disproportionate impacts on immigration or on women or on aggravating existing racial divides. So there's so many different intentions or motivations to even look at an issue like that. That is, that I think in a really rigid hierarchy has been categorized as like an E issue. And so I think there's some of that naming. That's I think a human way of thinking about this categorization problem and standardization problem running into a client and just an investor interpretability problem.
Mm-hmm. Yeah, well, and I think this kind of leads us into Catherine's question earlier. We're going to move into the group talk now. Because, Catherine, if you want to come off mute and kind of, I was thinking about what you were saying about actually making change, right? And so if we're getting kind of into individuals being like, I want to align my investments with my values, but then how do we make like broad change using ESG data? Is that kind of how you would categorize it?
Yeah, I'd love to hear people's take that are close to the work.
Yeah, I think for me, the most traditional one of exclusion, I agree with you, Catherine, that overall the limited direct impact there. I think of that in some ways like voting. If a lot of people are doing it and exclude, then there's potentially some impact there. I think it's still a worthwhile thing if clients, both from a client preference, if the client wants to take a cleaner approach and avoid investing in Exxon, that one client likely not going to have a huge impact on Exxon, but it's maybe good for that client. And then in aggregate, if there are thousands of people doing it, there could be some impact. But I agree that's overall fairly limited direct potential impact. I think, indirect impact there is to your point about any legal or framework changes or engaging governments in making changes to laws. I think if the SEC or others sees that there's more people divesting or excluding from a certain industry, or if there's more people engaged in that, then that's also quite indirect, but some potential to potential movement there. I think it's probably not as related for clients to do. It's, I think, probably a separate issue to engage lawmakers on. I think that shareholder advocacy is also, I'd say, not a huge immediate impact, but there's potential there. It's still too small of a group that is doing that actively. I think there's a lot of there's a lot of potential for direct impact there. It's just still early in that process of building the infrastructure to do it effectively. It's large pension plans, large asset managers who have power to do that, also obviously bound by their fiduciary duty. So potentially some legal changes there could be helpful. But there are a lot of more impact-focused asset managers who are much more active with their proxy voting, with engagement. And I'd say that is definitely on the rise. The larger firms are doing more of that and hearing more demand for that from investors. And I do see a lot of opportunity there. It's still early as far as the infrastructure to do that effectively at scale.
Yeah, I love the framing of that. And I think that there's a huge, in all of those different problems, there's a huge role that data plays in actually making change in terms of where do you focus effort. The shareholder engagement question, I think, is a really interesting one, because when you look at you have limited effort, right? It's hard to run a successful shareholder engagement campaign. So say you do have the resources. This is something I'm actively grappling with at the moment. Say you do have a team, hypothetically, you have a team of people thinking about impact, sustainability. How do you choose where to focus your effort? What are the different financial attributes of a company that would make it a good target for making change? And where would you not focus your efforts at all? That might be eventually in a full manifestation, I think, of what the investing and impact landscape looks like. Is we would have a data-driven way to go, okay, because of the company's performance, earnings, the business that they're in, and the practices that they have, and the change that we're actually advocating for, this group, we're not going to allocate dollars for, and we're going to take more of a divestment thesis, versus a company that you do think is in a position to actually be able to make the changes that you want. And then from there, how do you actually orchestrate that and get that pass through, working with fund managers who are controlling a lot of these different voting rights, and working with individual investors and things like that, to actually orchestrate more of like a what I think in politics is more of a community organizing type model for shareholders. I think is a really, really interesting place where data can also help guide us towards how we make good decisions about where to focus effort, and how to make decisions about resource allocation versus engagement. There's just as I was saying that there's an interesting piece of legislation as well around, I think it was, again, don't quote me on this, I think it's Republican sponsored, but it's looking basically at the power that fund managers hold in terms of shareholder voting power. And so many people are invested through these funds, and the fund managers have voting rights. There's legislation basically to pass that voting ability out to the actual end investor, which makes it way more similar to a normal democratic system than it does where you have sort of concentrated power in a bunch of fund managers whose incentive to vote against certain corporate behaviors or whatever shareholder originated items, their incentives might be quite misaligned. And I think what we've seen historically is some of the interests of the financial world and the corporate world can stay quite aligned if no one is saying, hang on, that doesn't seem like something that benefits everyone, that it seems like there's impacts there that we haven't thought about.
Yeah, I think it's great to kind of hear what you're saying, and with both of your comments, I think the end result is critical mass, right? Like any of these things can't, on a very, very small scale, is just a drop in the bucket. And so I mean, what I would love, and this is the case in the nonprofit world as well, just like combining resources, like rather than every separate company kind of like reinventing the wheel and like working on a certain project that's like very aligned with what another company is doing. And like, if there is a way to really put heads together to share best practices and like create that critical mass. I know the like ICCR, the Catholic nuns that have been doing shareholder advocacy for a really, really long time. Like, you know, there's just so many players that it does, as I think about the potential for this power of voting to become in the hands of every shareholder, it will be overwhelming, and people will still won't know exactly how to like implement it. And so then there needs like to have a centralized, trusted resource that people can go to, and just to make it easy, because we all know what you know, how busy lives are and how difficult it is for us in this space, I think, to let alone, you know, the complicated layer there. So I don't know. I mean, I just, in my ideal world, like it would be a unified effort that, you know, we could really achieve that critical mass. Because otherwise it feels like a lot of duplication and redundancy that, you know, may or may not yield the impact that we're all striving for.
You know, yeah, Catherine, I was talking to Andy from As You Sow a couple of weeks ago, and it sounds like there is some of that happening where, well, kind of on both sides, right? And so it's where there's kind of more, not to politicize it, but kind of like more like Republican leaning values are coming together to do a lot of shareholder engagement and pressuring pension funds and different like large organizations to not invest in them. And then As You Sow is like a little bitty company, you know, they're coming together with a bunch of others to kind of fight against that. And so I think some of that is happening and the landscape is shifting, but I think as advisors, you know, how do we talk to our clients and how do we implement that using, you know, things like ethic and, you know, sorry, ethos. I actually use the ethos in my firm. You know, like, I think that's kind of a bigger question for, you know, advisors is how do we implement it?
Bob's raising his hand. I think I'm curious to hear.
Go, Bob.
And Frank also has his hand up too.
Oh, go, Frank, after Bob.
Well, I guess I'll start. I think it kind of goes, well, I'll jump on here. Part of it is finding the fund managers. We have Green Central in the call here, greatly engaged shareholders. I think pooling a lot of resources this way makes the voting much more efficient. Part of my process is to find the fund managers that are actually doing engagement. You can get a similar portfolio elsewhere, maybe for a slightly different, like slightly lower expense ratio. But I do think the engagement matters. Part of it also is the conversation with the end client, where like, if you're just looking at like a mountain and like, it's overwhelming, but once you started going up that climb, you have the discussion, or you know, like it's the baby step. If you have the conversation with clients, make them aware of like, this is how you invested. Maybe they think about it in the day-to-day. Maybe they buy a slightly different product. Maybe they engage in a community group. Maybe they, you know, like they get more engaged. It's not one size kind of fits all. We all know that like the investing is a marginal needle mover, but I think from a behavioral aspect, it can have a big impact on the end investor by, okay, you are investing in a way that you care about. That makes them more likely to take steps to further engage in the issues in their non-investment life. And then having the right fund managers that can do the engagement and get the company working. That's how I see it. So it's a kind of like a multi-layered approach to it, and I think that's where having a report like Ethos creates some of that transparency for the client to, okay, you're doing this, maybe at a cocktail party, they'll talk about the values, the investment line, and other people are like, oh, wow, let me get on board with that too. So it's not like little rings in the water. I think it adds up over time.
I think there's something really exciting happening where all of these different forces are coming together. You need everyone looking at this problem from a bunch of different lenses, and then you need to translate that into action. And I think there's some really, I think one thing that came to mind to share is we met a really interesting organization called Tomelo, and they're working on this exact problem: is how do you make, it's enough of a hurdle to get someone to understand that they can vote on issues at companies with the shares that they have. That's one problem. The second problem is then understanding, okay, are you interested in voting? And the third thing is actually orchestrating that. That whole infrastructure problem is such an interesting technology problem, and they're building a lot of that, the pipeline of making it very easy for someone to go, yes, vote for climate disclosure, and have that actually pass through, pull their holdings, know how many shares they have, actually cast the vote, report back on how it went, and all of that infrastructure. So there's some really interesting work being done, I think, and this is where my deep belief in some technology solutions comes in, to make it, as easy. The example that came into my head is, how easy it is to sign petitions now, where someone sends you an email, you click on a link, you put in your email, you put in a little bit of demographic information, your zip code, and it verifies and then passes that through to your senator. You can even do it over text. I think there's some really interesting technology solutions that just, they take all the infrastructure burden and connect you closer to, you can intend to do something and have a very easy, relatively easy, very smooth and low effort way of actually implementing that. And so the problem then becomes sharing information and community building, and what's shareable content that you can go, hey, here's a 30-second video, and here's Catherine talking about why this is important to her and what you can do about it, and you can share that to 100 people super easily. I think that's where I think some of the positive elements of online community technology and content come in, that I think historically have maybe not been used to build communities that we'd like, but it can also be used for good in a really powerful way.
Yeah, that's awesome, Rebecca. Dan?
Yeah, I would agree. I'll just wanted to note, my colleague Dan has his hand up, and he mentioned Yusuf as a good organization, but Dan, do you want to add something there?
Yeah, well, I mean, one thing I didn't want to do is just totally discount the impact of kind of the indirect just changing of capital flows and how that changes incentives for corporations. And one thing that I think is kind of happening behind the scenes that we don't hear all that much about, and I'm going to use NASDAQ as an example, right? NASDAQ is a company that helps bring companies public, gets their stock out into the world, and then of course they're incredibly incented to see that stock price do well. And in the last 3 to 4 years, NASDAQ has built this enormous ESG consulting arm to go out there and say, okay, if we're going to bring your company public, we have to make sure that you have certain sustainability practices in place, so on and so forth. Because if we don't, then we can tell you that your stock is going to be cut off from anywhere from 35 to 40% of all the capital in the world. And that's incredibly motivating. So I think there's a lot of kind of simple things sort of happening in the background like that we need to actually recognize and appreciate. And if I could just say one other thing, which I think is really funny when it comes to this impact conversation, is that the detractors from sustainable and responsible investing for years kind of made this claim that it was all smoke and mirrors, and if you sell a stock or divest, it doesn't matter because somebody else will just buy it. Fast forward to 2022, those same exact detractors are now blaming, all the ails of the world on ESG, right? And the whole reason that gas prices are high is because of ESG. And so, on one hand, it's been totally smoke and mirrors, and on the other hand, it's like so effective that it's going to be able to crash the entire global economy. So, of course, the reality is somewhere in the middle. But I just thought that shift that we've noticed this year is really interesting.
Well, and I think that shift has actually brought ESG to people who've never thought about it. And so it's kind of like their own worst enemy is projecting out, what's happening in the investment world. So yeah, interesting stuff. Yeah. Does anyone else have one last thing they want to add before we kind of tell you about Advisors for Good and how you could get more involved? No.
Igor has his hand raised. Sorry.
Who does?
Igor.
Oh yeah, go Igor.
Hi, I'm Igor Zuckerman. I'm actually one of the partners of Advisors for Good, and I have my own firm, Eureka Wealth Solutions in New York. where we specialize in thematic and impact investing. I have a question for both of our guests today, specifically about data. Hopefully won't take too much time, but basically when we started looking at the ESG data back, I guess in 2015, we noticed all the things that unfortunately are still true today, which is, you know, data is bespoke, it's not audited, it's hard to interpret, and on top of that, it's expensive, and it's still the case. What do financial advisors or wealth managers, small and medium size, do? How do they implement it in their practice? And this is still a question we get from a lot of other people. So specifically, there seems to be two possibilities. One is go with the fund manager that we just discussed, or go with companies like yours and rely on that. So two-part question. One, what do you think should happen beyond standardization and legalization to make this data available and affordable for financial advisors the way, let's say, financial data is? And two, until that happens, how do you communicate to your advisor clients that your data or the way that you are dealing with that data is the best option for them?
I think thanks, Igor, for the question. One, I think ESG data is becoming a bit more of a commodity. It will continue to become more of a commodity where it will get less expensive. I don't know, there's a lot we can do in the meantime. I mean, Ethos, we are much less expensive than our other larger data providers as an earlier stage company. There are other startups, others tackling this problem and providing lower cost data. That will continue to be the case, I think. Then as far as communicating to clients, I think transparency and what your intent is, being clear on those things. So showing data and then also being clear, here's what we're trying to do with this data. We're trying to point to alignments with your values or impact, and here's the sources that we believe are relevant to that question. So if you're looking at a client who cares about climate, we're using X, Y, and Z, carbon, environmental science, other climate-related data points that we believe are most relevant, most credible for that values question. Something that Ethos we try to do is make that personalized assessment and personalized reporting very easy to do. There are plenty of others who try to do that as well. I think that's the personalized approach, be able to show that and tell that story is important.
Yeah, I would add, and I'm obviously biased. I would say, you know, we are a team where we spend a lot of our time doing this. If I had to distill what we're doing and why it's important, you know, you have two pathways. You can work with someone that's, or three maybe. You're looking at funds. You can try to do it yourself, or you can work with someone and find someone that will be a good partner. In those second two buckets, I think if I had to distill down what we're doing that I think is good, that I would be incredibly happy to share with people, is that I think one of the biggest challenges is that because this hasn't been a function that's been defined in financial services before, right? There's not a sustainability, my role on a sustainability specific team, I think is not something that typically an asset manager has, or that they're a little bit separate from the core business. And so I think there's an element of it where if I had to distill what skills do you need in there in order to actually do it in-house, there's obviously a cost element and a team element. I think if I had to distill it, there's a data quality and processing and management skill that you'll probably need on your team in-house. I think that's a huge barrier, honestly, to a lot of people being able to do this themselves. That's not, when you look at like an analyst or a portfolio manager or whatever it is, there's not some of the data systems and management skills that you might need. And then there's a huge interpretability gap. I think exactly what Luke was saying was someone has to make sense of the data and decide what's relevant. And with an increased pressure on regulation and making sure that the products that you're building are adhere to certain regulatory standards, or because of all these challenges that you've mentioned, there's a huge intersection of that data integrity with interpretability, and saying we're going to use this carbon data and we feel good about the methodology and we feel good about the coverage and consistency that we're applying in order to actually implement this in a in a client's portfolio, or use that in an actual investment decision. So I would point to, I think, some of the skills that you want on the team in terms of actually managing that data infrastructure, and then also interpreting the both quantitative and qualitative or more research-driven sides of doing that relevance to the actual client request.
Yeah. Thank you, Rebecca, Luke, everyone who joined today. This was such an informative discussion. I feel like I learned so much, and I really appreciate everyone engaging and being here. Advisors for Good, we're an awesome group of advisors who are trying to, do exactly what we did here today, like learn from each other, keep growing. It's, an ever-changing environment. So it's really fun to see what's happening, talk to each other. We have meetings the first Thursday of every month. You want to take over, Bob?
Yep, that's right. And I would just say that, we formed this group to kind of fill a gap where much of the ESG ecosystem is populated with the largest asset managers, right? And, if you were kind of building out the ESG ecosystem, you would also go after those who have, trillions of AUM. But that leaves the kind of independent advisors like us kind of sitting by the sidelines. So part of the motivation was, okay, maybe we can band together the 500,000, whatever the number is, 500,000 independent financial advisors. All of a sudden, like, okay, even if each advisor is managing only 20 million, that number becomes a larger number where as a group, we can begin to have some impact. And so we, at least my thought was, can we kind of bring advisors together to both build community and also have impact? And you need both, right? You need the community, the numbers to kind of have that impact. At the same time that, without the impact piece of it, your community is just kind of foundering based on things that really without some kind of purpose or vision. And so, and on the impact side, I love this discussion because, we're still at kind of ground floor to figure out, how do we deliver on impact and as a group. So in any case, there's a lot to discuss. One other thing is that it pointed to, a lot of this discussion pointed to how much it pushes us as financial advisors to really engage with our end clients, right? Many clients who come to talk about ESG are already involved in some way, engaged in some way with some of these causes and issues. They may be involved with charities, they may be involved with nonprofits, and this piece of it, and this Catherine brought this up at the very top, is just another part of what they can do as registered voters, as consumers, as community folks. And so they are also investors, they are retirement plan participants, but it pushes us and puts us in a place where we really can engage with end clients to really understand what their motivations are, and perhaps on the investing side to kind of bring some specificity around what we can do realistically in terms of impact, values alignment, as well as risk mitigation, so that we can actually make it happen for them. But this is just a small piece of it. So any case, this is what we like to kind of build out with more advisors, and maybe we can kind of share best practices on an ongoing basis. So thank you, Luke. Again, thank you, Rebecca. Thank you, all of you, for signing on today. And have a wonderful rest of your day.
Thank you very much.
Thank
Thank you, everyone.
Thanks for having me.
Thank you.
Thank you all. Thank you.